everyone, my name is Masud Rahman. I'm an economist with the UN High Commissioner for Refugees. This week in the Green Entrepreneurship course, we will be looking at an overview of the main financial statements for a business. Some of you might have seen my lecture about the balance sheet. In this lecture, let's try to connect the dots between all the pieces of information you know by now about the three financial statements. In this course, we've talked about external financial statements. These are the statements that are usually available to stakeholders outside the organization, and they will provide the minimum information that can be shared with outsiders without spilling out the secrets and confidential information of a business. These are the statements that you, as green entrepreneurs, will be managing. We're talking about the three statements: the income statement, the cash flow statement, and the balance sheet. If you have watched the preceding videos, you've already learned how to read and prepare these three statements. You can always go back to lesson 5 to review the details of the constituent parts of these statements, and in this short video, we will try to draw a summary of the relationship between these three statements. Let's begin with the income statement. Think of it as a profit and loss statement. This report is prepared to cover the full extent of one financial period, and it records the performance of a business in that specific period. Sometimes it is prepared monthly, but more commonly it is prepared either quarterly or even annually. As you have learned, an income statement will be typically made up of two sections: the gains section and the expenses section. The gains section will record earnings from sales revenue, earnings from any investment made by the organization, and earnings made from disposing, let's say, of any assets. The expenses section will cover all the money the company has spent over this period in terms of cost of goods sold, administrative or overhead expenses, equipment expenses, commissions, advertising, interest paid, legal expenses, and such. Once you deduct the gains from the losses, you will find the net income, or sometimes the net loss. It is fairly common for new startup businesses to report a net loss in the first few years. You might find that this will be the case for your business as you're starting out. And that's okay. It is important to never form an opinion based on only one financial statement. Always remember to assess performance by looking at all reports available to you. Next, what do you know about the cash flow statement? You know that, similar to the income statement, it is reported for the entire duration of the financial reporting period. When you first learn about the cash flow statement, it might seem similar to the income statement, as you will see that it's recording movement of cash to and from the business. In reality, this couldn't be far from the truth. A cash flow statement does not show profits or losses of a business. In fact, it illustrates the sources of cash for a business and how the business used its liquid assets, which are assets that can be readily turned into cash within a short period of time. And by short period of time, usually we talk about one financial period. Generally, a cash flow statement will explain to investors if the business has a diverse source of earning, revealing its risk profile. At the same time, it will also reveal whether the business is spending its money wisely in the right places. Always remember that you shouldn't be trying to assess the profitability of a business while looking at the cash flow statement. For this, you must refer back to the report we just discussed, the income statement. Now lastly, as we talked about in another video, you also learned about the balance sheet. Remember that a balance sheet only records the financial situation of a business at any one point in time, generally on the last day of the financial reporting period. Now this report shows what assets are owned by a business on the day of the reporting period and what it owes to its shareholders and external stakeholders on the very same day. One big mistake we often make is that we try to ascertain the current value of assets owned by a corporation when we look at balance sheets. Unfortunately, balance sheets often disregard the current state of assets or use an arbitrary scale to factor in time. And when they do that, this can result in misstated long-term asset worth. Remember, not to fall into this trap. Now, I want to leave you with one final thought that I hope you will remember from this week. I know I said it before, And allow me to say it again. It is important for you to read the three financial statements in conjunction with each other and complement your understanding of the financial performance of the business by also reading the notes and assumptions section in annual reports to see what special measures or assumptions have been made by the organization which led to the recorded performance. Small businesses may not have these notes and assumptions in their financial statements. In this case, you can assume that they are following the generally accepted accounting principles that are practiced in your country. To better internalize all the information about financial statements, I'd personally recommend that you look up the annual reports of a company that you're familiar with and see if you can use the knowledge you have learned in this week to understand the performance of that business. Feel free to come back and request clarifications or help your fellow peers out in the forum section. Best of luck.